Welcome to our show. This is Las Vegas Real Estate Now, where we bring you the 3 E's: educate, empower, and engage. We want to help you to make your real estate decisions wise ones for you and your family. I'm your host, Harvey Blankfeld, the Blankfeld Group at Berkshire Hathaway Home Services, and we have over a century of collective real estate experience. I'm a licensed agent here in Nevada. My NRED number is S.00488897. On this program, we're dedicated to delivering timely, balanced truths about local market conditions. If you ever have a question or an idea for the program, please call or text me at 702-203-1165. Again, that's 702-203-1165. Today on our program, we have some outstanding returning guests for you. We have John Ingram and Todd Cox. Welcome, guys.
Hello.
Great to be here today, Harvey. Thanks for having us.
Glad to have you back. We've got a bunch of things I want to talk about today. And Todd, I want to start with you.
I'm sorry, we don't have time for that today. Let's. Thanks for everybody listening in. No, I'm kidding. All right, let's go ahead and talk about what you want to talk about.
Thanks, John. Thanks for that, John.
Let's skip right to the end of the show. Make somebody happy.
Yeah. So, Todd, what? I've got this note here. What is BOIR? What is this?
Well, voir dire. It's a legal term.
That's Boyer. That's V.
The old Boyer reports that have. So last time I was on, I talked about them, and it was like
I remember this.
They were on again, off again, on again.
Right.
And
are they on again?
So what happened is in December they came back on again, right? Mm-hmm. And this is the where you have to report your ownership of your company,
right?
And then all the owners who own it, and.
So it's not as cloudy as it used to be. It's much more transparent.
They called it the Corporate Transparency Act.
There you go.
That's what it was called.
There you go.
And so they challenged the act, and they were in federal court, and they pulled down the reporting requirement, and then finally in December they put it back on, and then in February. They put a hold on, say, okay, you don't have to file, but by March we're going to give you a final rules of what you got to do.
Right.
And then finally on, I think it was March 2nd was when they issued the rule, but it was like March 23rd when I got the final email from them that anyone who is a U.S. citizen and if it's a U.S. company and a U.S. citizen. It has suspended. It's not required to file, so you do not have to file for the Boyer reports and the whipsaw seesaw.
Okay,
sorry. Is like if 100% of the owners are U.S. citizens, no report is needed. But if one owner is foreign national,
So if there's foreign ownership, it needs to be reported. And if there's foreign ownership, I recommend that you talk to your attorney about that. You know,
I would.
But if there's not foreign ownership, if it's just Harvey Blankfeld's ice cream truck, and
hey, don't bring up the ice cream truck.
Well, the ice cream truck is awesome. I got to promote. So, anyways,
deep fried ho-ho factory.
Yeah, John Ingram's ho-ho factory. Here we go. That
I can only do that in
those are not required to be reported. So essentially, they considered it a violation of the right to privacy, that kind of thing.
It's interesting. It's funny. Carly and I were just talking about this morning. So when you take a listing, when somebody wants to sell their house, they have to declare whether or not they're a foreign national. It's important because we have FERPTA laws where they basically have to have withholding. Money has to be withheld because the IRS wants them to pay taxes on whatever proceeds they generate.
It fundamentally changes the nature of the transaction.
It absolutely does. Now, the question I'm thinking of is you're saying that because normally an LLC masks that and makes it not necessary. A U.S. LLC says not necessary. But I wonder if there's a foreign national involved in that LLC.
Yeah.
Is that going to change the rules? It might well change the rules.
Right. And this is a report that's required to be filed with the FinCEN wing of the Treasury Department, which are essentially the criminal investigation guys. They're the anti-money laundering. They're the report on foreign bank account reporting guys.
Okay.
And they're the ones. They don't have calculators. They have guns.
Right. Wait, so just like your favorite movie, The Accountant.
Well, he's got both, but
yeah, he's got both. That's right.
Calculator.
Yeah. And then The Accountant 2's coming out.
Yeah,
I saw it.
Very excited. Oh, you seen it?
Yeah, it's out. Yeah, I saw it.
Oh, is it good?
Yeah, it was good.
I got to check it out now. The tax season's over.
Yeah, the real accountants can't see it till after tax season.
I've been in a tax season isolation cave. so.
I believe it was strategically released on the 16th of April. I'm not sure.
Yeah, I don't know that. Yeah.
I'm not 100% certain, but anyway. Okay, so
if Hollywood specifically marketed for accountants, the effort was probably lost on accountants.
it probably was. Yeah, if they brought it up before that, I was like, what? What happened? Who?
It was what? Yeah.
Okay, so we've got a new tax bill or a tax bill. What's going on with the new tax bill?
Yeah. So there's been announced a new bill coming. The House has marked it up a little bit, and it's been back and forth. And there's all kind of there's the campaign promises: no tax on tips, no tax on Social Security, and no tax on overtime. Obviously, the devil's in the details on these things, but.
Right.
Ultimately, so right now, if you receive Social Security, and that's your only source of income, it's not taxable anyways.
Oh, okay.
But if you have other sources of income, if you've got an IRA, if you got a 401k that you're got to take required minimum distributions out of, and it at about $15,000 to $20,000, it starts bringing it into taxability.
Okay.
And then at over $30,000 of external income external to Social Security, it brings it into like the full Social Security taxability amount, which is it's 85% of the total Social Security is the amount that's eligible to be taxed.
Okay.
So if you got $10,000 of Social Security benefits and you got $30,000 of pension income that you get from retiring from the school district, well, then you're going to have $8,500 of your Social Security will be taxable.
So now taxed on $38,500.
You don't surrender $8,500, but if your tax rate's 10% and you've got $8,500 of your Social Security, then you $850. So
and so that's currently the way it is, and now but the new bill would make it completely
this change
exempt.
would say, hey, if you whatever your Social Security is, it's never eligible for taxation.
Okay,
it's going to be shielded from any tax.
Having just turned 65, this is very exciting for me.
Well, then the other thing I've got is the tips. So tips is a big deal. And, there's a lot of talk out there that this tax bill only helps the rich and blah blah blah.
Yeah,
and certainly I've got some discussion points that we can talk about later if you want to talk about it, but. Certainly.
I got some stuff to get into on this.
It does help the rich, but the rich pay a significant amount of the taxes too.
Right.
So I mean, it's hard to change the tax bill and reduce taxes and not have the rich affected. Obviously,
of course.
But
the rich aren't getting tips.
The rich aren't
certainly
getting tips.
will after this law gets passed.
Sure.
How many hedge funds will change their income from cap gains over to tip income?
There you go.
Because I have the right to decide how I'm going to treat that money,
I think that's what I say. The devil's in the details. If you're in a non-traditionally tipped industry, you're going to have a hard sell to an IRS agent to say that
only if they write the rule that way. You know what I mean?
Which
if they write to
will.
make it hard, sure.
But here's what I wanted to talk about. Right now, there's a gift exclusion of like $19,000.
Right.
So if you wanted to gift one of your children $19,000, you could do that, and you wouldn't have to affect your unified gift tax credit, right?
Okay.
And so you could, or if John wanted to give you and me $19,000,
I can give $19,000
each one of us $19,000, and then
there's no tax.
And there's no tax. There's not a deduction for it, but there's no income to the recipient, right?
All right.
But if I'm working at a parking cars and I park John's cars and he's like, hey man, thanks, here's $5, I've got to pay tax on that, and all of a sudden my boss has to get involved in what's that.
Right.
And so, but if you take the fundamental nature of what's a tip, it's a gratuity, it's a gift.
Yeah.
And if we consider it under the gift tax limits, unless John gives me $20,000 for parking his car as a tip, then I shouldn't have to recognize any of it as income.
Okay, guys, I'm gonna interrupt right now because we're going to talk a lot more about this, but we got to take a quick break.
Todd's not getting off the hook on this.
Run a few commercials and come back. We're going to talk more about taxes on tips, taxes on Social Security. Let's find out what's happening, guys. Stay tuned. We'll be back in just a minute.
All right.
Very good.
Am I the only one that is guessing how much strippers make in tips?
I think you're guessing how much strippers make in tips.
Wow.
I'm guessing.
Fingers.
I'm guessing. So there's
Most of their income. I'm just curious.
no. So they most of them.
How many doormen know you by name, Todd?
Most of the strippers pay to dance.
Oh.
They pay a fee to dance.
Yeah, the house gets a lot of that money. Yeah,
and they keep their tips. So
But
so if there's like
So
a
they're-
$500 per night fee for them to dance, and then
Wow.
so they're paying the place.
Todd does know a lot about this.
well, he does their taxes,
it's a-
Carly.
oh
my goodness.
Yeah,
Todd.
It's an industry necessity. So
It is.
Yeah,
That's right.
there you go. All right, let's come right back. Segment 2. Here we go. We're going to get right back into this because
Yeah, let the prosecution start.
Okay, here we go. All right, segment 2. Here we go. Welcome back. I'm Harvey Blankfeld. You're listening to Las Vegas Real Estate Now. We're here every Saturday at 11 a.m. You ever have a question or an idea for the program, please call or text me at 702.
203-1165.
Again, that's 702.
203-1165.
With me now in studio, we have Todd Cox from Todd Cox CPA. We also have John Ingram here talking about mortgages, and we're going to get into that in just a minute. But I still want to finish up with Todd here and talk about this tax bill highlights. And okay, so the idea currently right now, as you pointed out, Social Security is not taxed unless you make certain other supplemental income, and then it can be taxed. Tips are currently taxed.
Yeah.
And that maybe that goes away.
Well, what's the reality of that? So I got to call this out. So most tips, I'm going to throw out a blanket statement here. Most tips go untaxed in our society because cash tips are very rarely reported by the person earning those tips. If you look at the restaurant industry, the bartender industry, they don't generally, I know I'm making a blanket statement here, they don't report cash tips. There's tip compliance that gets done. Credit card tips get reported and have to get taxed. But the bulk of the money that comes in cash is entirely untaxed. Todd, you're a CPA. You prepare people's taxes. How many times are your consumers asking you to do, hey, I have this unclaimed amount of tips that I want to pay taxes on?
No. Most of the people who this is going to apply to are in a tip compliance program.
Right.
That's
the only ones that's going to help.
This is the hotels. This is the culinary union. I've got a client who's an attorney, and his the bulk of his practice is representing tip compliance. For the culinary union, representing clients, culinary union members who have a problem with the IRS because of tip compliance.
Right, because even the tip compliance amount.
Dealers. This is a Las Vegas specific issue because it's
really?
Dealers. It's all the dealers are tip compliance.
Yeah.
All of the valet parkers are tip compliance. All of the slot floor people, all of those people.
Well, let me ask you, in light of that, have grocery stores, have fast food restaurants, have all these places started to have to develop tip compliance policies too? Because I'm seeing their tip jars are out.
They've got tip jars, but
it's built into every credit card swipe now.
The thing is the IRS has to get a tip compliance program with each one of these people and with each one of these entities. And to the extent that they don't have a tip compliance program with, say, McDonald's or Burger King, well, I mean, I'm sure they have one with Starbucks, though. Because Starbucks is a typically tipped position, but fast food not so much.
Okay.
So I think that to the extent that this wants to be subject to abuse, I think that the regs are going to be clear enough that hey, if you're in the mortgage industry, you're not a typically tipped position,
right?
If you're claiming that your income is tipped income, you're going to have a Supreme Court case in order to overturn it.
Okay, all right, that's fair. Okay, so so the standard deduction is going to change.
Standard deduction is going to go up a little bit, and all of the 2017 tax law that went into place is going to be. They're trying to make it permanent.
Renewed.
That's on the agenda to make that permanent. That's the 199 Cap A qualified business income deduction. They're trying to expand that to. I think they're going to try and expand that 199 Cap A to other businesses that are excluded from it, like the specified service trader businesses, which are like doctors, accountants, attorneys.
Okay.
Those guys are excluded at income levels from taking the 20% deduction, and I think they want to expand that.
I see.
Whether that's good or bad, that's what's on the agenda, and then they want to reinstitute the 39.6% tax bracket for incomes over $5 million.
Okay.
So that's formerly the highest tax bracket before the current bill, which is now 37%.
Right.
But they want to reinstitute the 39.6%.
At $5 million.
If you have $5 million of income or higher, That's where they want to hit it.
Okay.
The right now, there's also the additional Medicare tax, which is like 3.8%.
Right.
So if you got the 3.8%, you got the 37%. If your income's at $1 million or more, or something like that,
right,
you're paying an effective rate of 35 to 37%.
Okay.
And then you're paying that additional Medicare tax. So you're over 40% of income.
Right.
On a 5-day work week, that's Monday and Tuesday.
Yeah. Okay. That's
Wednesday, Thursday, Friday, you're working for yourself. The other 2 days, you got an IRS debt to pay.
That's harsh. So. That is harsh. Yeah. But everybody else is Monday. They're working for the government.
Well, if it's 20%, yeah. Everybody works Monday for the government, but the higher income earners work more of a greater percentage of their work week for the other day. And that's why some of them just take that time off. I know some of my doctor's clients are like, I could do more work, but it's not worth it. I'll just
gotcha. They don't want to get over that threshold.
Yeah,
it's not worth it to them.
And that's why a lot of times they're looking to change it into the cap gain.
Okay.
So if you can get it into the cap gain regime, you're only at 20%.
Think hedge fund guys,
right?
Yeah, the hedge fund guys, all those guys, they're 20%. And so even though that's what they're talking about with adding the new 39.6% rate, if they add the new 39.6% rate, it still might not affect as many 5 million income earners as they want, because a lot of their income is capped.
They're not earning it based upon the sweat of their brow. It's based upon the multiplier effect of their money.
It's impossible to earn. I mean, not impossible. You can talk to some of the pro athletes to earn 39 million, but it's almost for you to do. You have to have a business that's doing something and creating
extraordinary.
income.
Yeah, it's got to be extraordinary circumstances where you're earning that kind of money. I can imagine. Yeah. And so when you talk about the cap gains, basically instead of a salary, they're benefiting from investments or other things as opposed to just a general salary.
Yeah,
it's not a W-2. There's not a W-2 involved.
They're selling an apartment building, or they're selling long-term stocks that they've held.
They're getting a commission or something other than that.
They got a stock option plan from their company, and then
I get it.
And then down the road, it's over a year that they've held it, and then they exercise the option and then sell it, and it's even though it might be $10 million, it's still only capped at 20% as the rate.
Let's talk a little bit about the distribution statistics. You were talking about. You kind of hinted at this before.
Yeah.
Let's talk about that.
So the distribution statistics of the tax code and of who's paying tax and how much and what levels.
Right.
Well, I can let you know it's me.
Okay, good job, John. I appreciate that. So here's where it comes in at about. The top 1% of income earners are with an AGI of about $660,000 per year. So if you're at that $660,000 per year income level and higher, you're
the top
1% in the U.S.
Okay.
Yeah.
Okay.
If you think that there's 350 million people in the country, 3,500,000 people are carrying this load, right?
Wow. Okay.
They're paying 40% of all income tax all tax. So 1% pays 40%.
Wow.
And they have 20% of all income distributed to them.
Right.
So of all the income that is out there in the country, they have about 20% of it.
Okay.
But they're paying 40% of the tax.
Gotcha.
So they're paying double the tax of the share of income.
Right.
So
Right.
if you got AGI of the top 10%.
Average gross income.
Yeah, the top 10%, if you got AGI of over 180, you're paying those people who have income of 180 are paying 72% of the tax.
Got it.
This is as of the 2022 statistics.
Okay.
I got a GPT for 2023 statistics, which is in line with this, but I can't find the source of it, so I'm not really quoting it.
Okay, you're not ready to quote that.
Yeah, because I know that sometimes the AI...
Yeah, it gets bad data.
They go into.
They don't know where they're getting the data from.
Sometimes it's nonfiction and sometimes it's fiction.
Just like people, AI can make mistakes.
Yeah,
we've seen that numerous times.
Yeah, they can become a toddler all at once.
There it is. Yeah, how about that? Hey guys, look, we're coming up on the bottom of the hour. I want to run a couple quick commercials and come back, and we're going to talk to John. And John, we're going to talk about credit.
Okay.
What do you think? You want to talk about credit?
I'm happy to.
I'm going to give you some credit to talk about credit, so we'll talk about credit. Okay, so guys, stay tuned. We'll be back in just a minute.
One thing I forgot to say is the bottom 50% of income earners pay 3% of the tax.
Okay.
So the bottom half pay only 3%.
But there's a certain threshold point where you don't pay any tax, right? You have to get to a certain number.
Yeah,
before you pay any tax at all.
If you have AGI under $17,000, you pay zero, or you get a net earned income credit. You get a net distribution to you.
Okay.
It goes backwards,
Right.
Not only does it not tax you, it gives you income.
Right.
So, and then I was thinking about one of the things, like as you were doing the numbers and stuff. So 1% of the people collect 20% of all the income in the country.
Mm-hmm. Yeah.
And then you're saying, but that 1% also pays 40% of the tax.
Yeah.
But you're getting 20% of all of the income. So it's not like it's not a total loss for them. Right?
No, they're still doing. They're
well, certainly.
You'd rather be the 1% than not.
Certainly,
100%.
yeah. And so I think I was watching one of the comedians on Netflix, and he was like talking about, well, that guy, the homeless guy on the side of the road, the problem isn't that housing prices are too high or that he can't get a job. I mean, you put him in a house and then you take him to work and give to the local State Farm agent, and you're like, here's your insurance adjuster, and you're like, that guy, that guy is high as a kite.
Yeah, right.
and he's tweaking right now, and I don't know.
I don't know if we can assure that. Yeah, how do we even assure that? Yeah, that's tough.
So I mean, I think the problems aren't the prices. The problem is, these people need fundamental help on a real level, on a mental health issue and
that's
a
the
medical.
Biggest thing.
Yeah,
that's the biggest thing across so many different elements.
Yeah, I mean,
mental health is such a big issue.
I mean you guys know that's why I kind of volunteered down and do the
I love that.
some stuff at the rescue mission, because I love those people, and if they're not served, they're not served by throwing money at them.
No,
throwing money at them exacerbates the problem. Yep. It enables it. They need somebody to walk shoulder to shoulder with them through the
just take care
the rigors of their day.
Take care, not just throw money at it.
Right.
Take care. Yeah, I get it.
Yeah.
All right, here we go. Segment 3. Yep, here we go. Welcome back. I'm Harvey Blankfeld. You're listening to Las Vegas Real Estate Now. We're here every Saturday at 11 a.m. You ever have a question or an idea for the program, please call or text me at 702-203-1165. Again, that's 702-203-1165. With me now in studio, we have Todd Cox, and we also have John Ingram. John, I want to talk to you
finally
about finally.
He's been chewing my arm off.
I know. He could barely get a word in edgewise. I know how
son
it
of
is.
a beat, Todd.
John's turn.
Yeah.
So, John, there's people out there, and it's tough on. It's right now. It's tough on first-time home buyers. It's tough on a lot of people. Credit is a big issue right now.
Sure.
And so, if there's someone out there who's currently renting, and they're saying, "Gee, I'd love to buy a house, but what do I got to do? I mean, how am I going to do that? I mean, they don't want. They're afraid. One of the reasons we do this show is to kind of help you alleviate and eliminate that fear.
Right.
But let's talk about credit.
So part of that process is getting your credit in shape.
Yeah. So what do they need to do to get the credit in shape? What's the steps? What do they need to do?
There's two angles where your credit's coming into play. Like when it comes to getting a mortgage to finance a house, there's the monthly payment obligations that you have and how that is, percentage-wise is compared against your monthly income.
Right.
And then there's the credit that you're carrying and what it does to the credit score that you have at the time, right? So it is both these issues are going to dictate what you're going to be able to do and not going to be able to do. There's this common instinct when people are preparing to buy a home that they will begin working on their credit. They'll think about, okay, how do I improve this so I have as good a chance as possible, right?
Yeah.
And a lot of these things that people do end up being mistakes or counter.
It seems like the right thing to do, but it's really not the right thing to do.
That's exactly right.
Yeah.
Exactly right. And so there's a few things. So let's start with the positive side. If you want to improve your credit score as rapidly as possible, you simply pay down credit card debt.
Right.
Mm-hmm. Pay down your revolving debt obligations.
Right.
So this is credit cards effectively, and so
pay them down. Don't close the account.
100% agree with that.
Yeah, pay the balance off every period. If you can pay the balance off,
If you can afford to do that, if not, at least shrink that balance.
Yes,
At least go after the balance. But
And there
don't
are
close the account.
lines there, right? So inside the credit score formula, it's a black box, but effectively what it does is this. If you go above 50% of your credit limit, it begins actively pushing your score lower.
Yeah.
You're gonna drive your score down and down and down the higher you go above 50%.
Okay.
So milestone number one in my mind is simply get it out of max and get it below 50% of your credit limit.
So if my credit card says I can spend up to $10,000, once I cross 5, I'm starting to diminish my credit score.
Yeah, when you go above 5,000, you're going to be actively pushing your score down.
Got
And
it.
this is looked at on an individual account basis as well as all of your accounts combined.
Right.
So if I have one card that's maxed out and it ends up being, half of my total available credit, that's a bad thing.
I see. So it's not the individual cards, it's the
It's
total
both.
sum.
It's
Oh, it is both. Oh, okay.
It's both.
Okay.
And so, so you drive, let's say that 10,000 credit card, you get it below 5,000 in your balance. Now it's no longer pushing your score down. It's kind of in neutral.
Gotcha.
Right? In that 40 to 50% range, you're sort of in neutral. As you get it going even lower, you get below 30% of your available credit. Now that's actively pushing your score up.
Oh, okay.
Okay.
This is great information. I'd never heard this before.
Yep. And this game can be worked out both ways, by the way. You can do this by paying your credit down, but you can also do it by raising your limits.
Oh, of course.
And that costs you $0 typically.
Right.
You know what I mean?
Get another credit card and don't use it.
Well, I'm just saying, double that 10,000 credit card limit, right?
There you
Take
go.
it to 20,000.
Okay.
Now what you're using is a much lower percentage. Now this is a solution for the credit score. It may be the pathway to hell for you, though.
Yes.
Of course.
If you get too much available credit that is more than you can handle, and it can take you down financially completely.
Yeah.
Right?
Yeah.
And so you got to be very cautious with that. But in general, if you're a good credit user and this sort of thing, there is no downside to having $1 million of available credit.
Right.
You know what I mean?
Yep.
There's no automatic harm that's done there.
As long as you can withstand the temptation to utilize it,
Correct.
unwisely,
Buy that
or-
private island on your credit card. Yes.
Right.
Yeah. This is, and I'm going to take a little sideways venture on this because I've been talking about this a lot lately. There's a lot of people on social media advocating rental over buying. And part of their argument is, hey, rent's cheaper than owning the home. Take that extra money and invest it. But that's not what people do.
They don't do that.
They don't do that. If
They
I've got extra
can,
money,
but-
they spend it.
Right.
It's eat. I'm going
They
to
invest
eat at
it
a
on-
nice restaurant this week, and I'm going to eat out every night. Whatever it is, if they've got the money, they spend it. They don't invest it. But if you put it in the house,
They invested
you
in
can't-
travel.
Yeah, right, or buying an island or whatever. So, but if it's in the house itself, you can't spend it, and your
Right.
house over time is appreciating, and your principal's going down.
Yeah.
That's how you can build personal wealth. Anyway, I'm
Agreed.
sorry to digress. I had to point that
that's
out.
fair. So paying down credit card balances is the first go-to if you're trying to improve your credit score. Let's say your credit card balances are paid. There's nothing there. The next instinct people have is they go to start looking at their collections. They have this stupid $500 athletic club collection from
Oh, boy.
2 years ago. The problem here is that people pay those collections and they've done harm to themselves in their credit score.
Right.
And this is really driven around the fact that the balance of a collection has no impact in your credit score. Whether it's a $100 collection or $1 million collection,
Really?
that itself has no impact in the credit score. It's simply, when did this collection happen? When was the date of your last activity on this account?
Right.
That's what's really impacting it.
Okay.
And so when you go to deal with collections, which, by the way, I got to say this, there's not really any mortgage that's commonly used that requires you to pay collections.
Oh, okay.
Usually the worst case consequence is I'm going to hit you for some payment towards that debt into your debt ratio,
Okay.
imagining that they've come to collect on you and they force you to start paying.
But that collection affects their FICO score.
It does.
Okay.
So whatever damage is in the FICO score is there, but the mortgage is not going to tell you no simply because you have a collection.
Gotcha.
right?
Okay. All right.
That's
That makes sense.
not a thing really anymore at this point.
It's
But
just going to compensate for it.
yeah, I mean the damage or the risk that's being taken into account is reflected in the credit score.
Got it.
And so you're paying more for
and
that
your
loan
effective
or-
rate.
Yeah,
Okay.
exactly right.
Okay.
So the key with collections is you simply want to either leave them alone,
Right.
or you negotiate with that creditor to agree to delete the collection as if it never existed.
Go back to the original creditor, not the collection company.
You may get into a little bit of it's possible, but not always successful.
Yeah,
But here's the thing.
they've already sold it to somebody
Yeah,
else.
If the lien's been sold
Right. You're not going to go back to your cable company company and get them to buy it back and things like this. In many of these cases, the collection company has purchased that debt from that company, and so the business is over, right? But here's the thing: is there's nothing in the credit reporting rules that says they must report bad things about you, right? There's no rule that says I have to talk bad about you, and so they have the power to delete it as if it never happened. And so you make this part of your negotiation. You want $1 from me, collection company? Then you're going to agree to delete this as if it never existed, and then I'll pay you this amount of money. Right? That's absolutely fair. That's how businesses
and they'll
would
do
work.
That.
They can and will do that. For sure. Now, the first person you talk to on the phone may not say this is possible.
No.
They may say it's against the law. All these things are not true, right? They have the power to do it if they want to do it, right?
Good information.
So, and here's the big key in my mind is anytime you come to an agreement with them, you get it in writing before you give them 1 penny. As soon as you give them $1, they've got you. Because you've just reset the clock on that debt for 7 more years.
Oh, my.
That they get to try to collect it for you. They can keep it on your credit report. It's not going away.
Wow.
Right? And so it's all based upon your activity. And talking to them is non-activity. It's so checking
negotiation
on it. Negotiation doesn't count as activity to reset these clocks, right? So it's simply, did you pay them $1? Did you transact with them or not, right? And so that's the key devil in the details with collections is it's all geared upon when did that collection happen? Was that 1 year ago? Was it 1 month ago? And the older it is, the less damaging it is. And so you don't want to take a collection that's 4 years old, reset the date on it, make it look brand new. It's worse for you to have a brand new collection that's paid than a 4-year-old collection that's not paid.
Are you guys getting some good takeaways? Because I know I am. This is terrific stuff. But we're coming up on another break. We're going to run a few commercials. I want to talk more about this, though, John.
Thanks.
Because you're giving us some really good information here. For those of you out there who are renting and think I can never buy, the fixing your credit is not maybe as tricky as you thought. Maybe if we follow a few simple basic rules, we can get it done. So, guys, stay tuned. We'll be back in just a minute. A lot more to talk about.
Couple questions.
Yeah.
All right. So you say get it in writing before you pay $1. So literally, physically have the written document.
I want it from a company email or I want a letter.
And you don't have to send anything before getting that, or you negotiate.
You don't send them any money until you have the agreement in writing to you.
Wow. Okay, that's one. Two.
Then you exercise the agreement.
I understand. I was told this, but I didn't know to get the agreement first. All right, so the 7-year thing. After 7 years, it just drops off completely.
It can no longer be reported to your credit.
I was told that some of the creditors or collection agencies, they could redo something to keep it active within this.
They will often break the rules and reset the date or change the date of the activity and try to continue reporting it. But that's a violation of law, and you can fight with them.
You can challenge them.
You have redress for that.
Keeping up with it, by 2026, they're supposed to drop.
Yes.
You notice that they reactivate or set the date back?
Yeah, they changed the date on it.
You couldn't dispute that.
100%.
Absolutely.
What are the avenues? Who would you go to?
The first thing is to go to the credit bureaus themselves. Each one has a dispute process where you can say, this debt is more than 7 years old and should not be on my report any longer. The credit bureaus has 30 days to contact them and get a response from that creditor to where the creditor says, yes, the clients or the consumer is right, or no, they're wrong and we're allowed to do this. And the dispute becomes decisioned at that point.
Do some of these creditors have the legal ability to garnish garnish wages?
If they were to take you to court.
Only if there's an order.
Yeah, they have to take you and get a judgment.
Order to garnish.
Or if they do judgment.
Okay. Yeah. They can't of their own power do it.
Correct. Yeah.
Okay, I received a judgment. Let me now hold on. Sorry, guys.
It's good stuff.
So we're at segment 4 already. Holy cow!
That can't be true. This is only the second break.
Yeah,
this should be segment 3.
It's been all that hot tax talk, and
we did two before we even got to you. Yeah, this is
okay.
This
if
is
you
it.
say so.
This is it. Yeah, the clock says so too. For sure.
Right.
Okay, so here we go. Segment 4.
Buona capisai.
Welcome back. I'm Harvey Blankfeld. You're listening to Las Vegas Real Estate Now. We're here every Saturday at 11 a.m. You ever have a question or an idea for the program, please call or text me at 702-203-1165. Again, that's 702-203-1165. With me now in studio, we have Todd Cox, and we also have John Ingram. And John, before the break, we were talking about credit and what you need to do to be thinking about your credit, whether you want to buy a home or just fix your credit. You just want to figure, the process of buying a home is is cumbersome for most.
Intimidating.
And intimidating, yes,
Yeah.
it is. And what we're trying to do today, right now, is talk to you about those of you who may have some credit issues. There's some ways you can fix it. You don't need to go spend. First of all, don't spend a lot of money fixing it. That's just silly.
I agree with that.
That's just silly to me. I mean,
And you certainly don't want to spend large chunks of money before you consult with an expert.
right. And an expert, honestly, John's an expert. John's an expert. He's a mortgage lender. If you're thinking about buying a
Over
home and
20 years.
you want some advice on how to get your credit, he can help you with that.
Sure.
Yeah, he's happy to do it. So you don't have, and you would charge him. How much would you charge him for that?
I'm not in the business of credit repair. I do not charge fees for it.
There it is. So
there
you
it is.
can. So if you're out there and you're listening to the program and say, "Gee, I want to fix my credit," and you're thinking about buying a home, give John a call and he'll help
Sure.
you out. Absolutely. So that's great. Okay, so we were talking before about we talked about
Credit card
collections.
balances and collections.
And collections. Okay,
Right.
so what other things? Now, what other elements should I need to be considering when I'm talking about my credit?
All right, there's this large instinct out there in the world for people to take big chunks of their savings and pay off installment loans. So think student loans or auto loans, these loans that have a fixed monthly payment that you're supposed to be paying, and they think I'm going to pay off my car loan and that will raise my credit score. And unfortunately, that is typically not true. The balance on an installment loan is not relevant to your credit score. So once again, similar to a collection where whether you owe $1,000 or $50,000 on that auto loan has no difference to your credit score.
It's really that payment.
Yeah, well, it's measuring
it's a
how
ratio.
long a track record you have for making that payment on time.
Gotcha.
How long since your last late payment? That's what's being judged is your activity there. The balance itself is irrelevant. And so when you go to paying off that credit, that car loan, your balance goes to zero. Did you improve anything? No, you didn't.
Oh, okay.
What
Interesting.
you've actually done in the longer run is potentially hurt yourself because you had this auto loan that was saying, look, for the last 3 years, I paid on time every single month. And oh, by the way, my most recent payment just 2 weeks ago was on time too. That's a great thing for my credit score. How positive is it for you to have an auto loan that said you paid on time 6 months ago?
Yeah.
Because you paid it to zero and it's closed now, but you were on time 6 months ago.
Plus, you also diminished your reserve.
Potentially, yeah. You're taking money that we could use strategically out of your savings, and now you're spending it on a loan that's really not going to move your credit score significantly.
Does savings account balances have an effect on your
It has
credit score?
an effect only so far as it gives you optionality. If a problem can be solved by writing a check, you still have the ability to solve that problem.
Right.
Without any money, you can't solve it. Right.
But if you have like a long-term balance in
We're
your
not
savings
measuring
account,
that,
is
no.
Okay.
No. Okay.
No, whether you, there was talk about bringing that into the mortgage business where we might look at your account for like the last year and see that, oh yeah, the whole time they had $20,000 in savings, right? But it's not really in the rules at this point to where it's something that people need to worry about. So paying off installment loans, that's not a good thing. And then one other thing that people miss sometimes is the idea of not having bad stuff on your credit is always ideal,
right?
But it's just as important to have positive things talking about you, right? Having open and available credit is part of having a great credit score,
right?
And this is, not the Dave Ramsey kind of stuff where I don't want you to ever have credit. I'm not a believer in that myself.
Right.
I understand what he's trying to do, but
Yeah.
I live in a world where I'm going to have to borrow money from time to time.
Absolutely. Yeah.
I'm not going to wait 10 years to pay cash for a car.
Right.
Yeah. When your air conditioner goes out and you got to pay $10,000.
Yeah.
What are you going to do?
Put a little bit of credit on that.
You got no problem.
I understand it's costing me money and it's a slower solution than paying cash. But anyways, so the best credit scores will have at least 3 to 4 open positive accounts about them.
Okay.
So that could be, and the mix of the type of credit also matters in the long run. But, whether it's 3 or 4 open credit cards or 2 credit cards, an auto loan and a mortgage, all this kind of stuff, that goes into the ability for your credit score to get to its highest levels, right? And currently in the mortgage business, the normal answer is 780 and higher is all the same. So once you get into that high 700s, you're in the best category and you're good to go there.
Okay.
There's no bonus point for being 850 versus 780, really.
Gotcha. Okay.
And so that's what, I'd encourage people to strive for. Anything above 700, you're in a good category. You're going to have most options available to you and you'll be fine for ability to borrow.
And that's your goal.
But what you're saying is if you have no credit and no credit footprint, then there's nothing to measure, and that's hard.
Yeah, it's much more difficult.
Have a footprint and make it positive.
100%. That's really one of the evolutions that our country went through was a time where we didn't have credit reports to a time where we did.
Right.
It changed the process of us having to go out and manually find out who you've borrowed money from and ask them how you did with that debt, how long it took you to pay it back, and manually create this history versus having a piece of, an electronic file on you that says, here's how you do.
Here's your profile.
And it made it significantly cheaper to borrow money. It made it faster to borrow money.
Interesting.
These are all the improvements that came with the credit bureaus. And I'm definitely not a fan of them. But that's the one good thing, right? It gave us a way to be able to quickly judge
the
someone.
efficiency of it.
Yeah.
Yeah, my dad used to do collections.
Long
before. So when they gave out credit, he would work for a furniture store, a jewelry store, and when they gave out credit, they would have to really dig into someone's background because they didn't have the FICO. They didn't have like you described.
It was a gumshoe job.
Yeah, basically,
you had to go out and hit the pavement.
You go talk to the bank, you talk to landlords, you whatever the case is.
That's exactly what they had to do.
And that process still exists in the world where a consumer comes to me and they have no credit history whatsoever. They're not simply a no.
Right.
There's just a harder, slower process for them to be considered and fewer products available.
And how much easier would it be for them just to get a couple of credit cards, establish some credit, borrow some money, and then pay it back?
You can go from a blank slate.
Create a positive footprint.
Yeah, you can go from a blank slate to a good credit score in 6 months.
I mean, this is the way that you can prep yourself to enter the housing market. This is what we're talking about.
Yeah.
It's not, and this might not be the long-term way that you always do it. But it is something that these are the steps that John's telling you that we should take in order to prep ourselves to receive a positive response from a mortgage company.
You're going to have a hell of a time if you're a person, let's say, who's avoided credit all of your life, and you want to go borrow $2 million on a mortgage. That's probably not going to happen, guys.
Yeah.
You need to have an experienced credit file.
Yeah.
And I want to point out a couple things that I've come to realize of late. First of all, it doesn't matter. It doesn't matter how good your credit is. You're still going to have to go through the entire process to get the mortgage.
True.
It used to be that the certain people were exempt from the process. That's not the case anymore.
There was a way you could earn your way out of the hard process.
Right.
Sure.
You got to go through the whole process. But one of the questions I always get, John, is this: is whenever I'm working with a buyer, and they want to shop mortgages.
Yeah.
They're concerned about their credit being pulled too often. Tell me about that. Is that something you should be concerned about?
This is mostly overblown, I will say, for most people. So this is all about hard inquiries on your credit. So good news that I can give you now is most of us in the mortgage business now have the ability to do a soft credit pull on your credit.
Okay.
Get all the information we get on a normal hard pull with no impact to your credits.
There you go.
So, no one will even know I've ever looked at your report doing a soft inquiry.
Okay.
And the reality there is with a soft inquiry, I can't actually loan you money.
Right.
And that's why it's not a negative on your credit score.
Gotcha.
Right? When I go to actually begin to loan you money, I have to eventually do a hard pull on your credit, which does show up and does take away somewhere between 1 to 6 points off of a person's credit score.
Gotcha.
That's usually not super substantial, but it's something you want to be selective about, but not fearful. So that's my attitude.
So when you get to the point where, guys, when you're out there shopping for mortgage, ask your lender to do a soft pull so you don't get dinged, and that way you can shop. Now they're going to know that's why you're doing it, but that's okay. I want them to know I'm shopping you.
Sure.
I'm not
afraid of that.
Yeah, let's not deal with a mortgage lender who's afraid to be shopped.
Yep, get up off your chair. We're gonna be taking a walk.
That's right. That's exactly right. Yeah. Hey guys, I got to say, what a fun real estate hour we've had. I got to thank Mark, our production director, Carly, once again for doing a great job, and I got to thank our outstanding expert contributors today. Great conversations today.
Yeah, good times.
Being John Ingram and Todd Cox. You've been listening to Las Vegas Real Estate Now. I'm your host Harvey Blankfeld. Next week, we'll have another fantastic hour for you. We're going to have Darren Welsh and Rick Senemy on next week.
Oh, Darren.
Darren's always fun.
Good times.
And Rick's always fun. They're both fun. You ever have a question about real estate or any of the topics we covered, just call me off air or text me at 702-203-1165. Again, that's
702-203-1165.
I just knew he was going to do that. Subscribe to our YouTube channel, that being LV Real Estate Radio. Like and follow us on social media, our handle being at LV Real Estate Radio. And I want to thank you, our listeners, for joining us this week. Remember, while we seek to educate, empower, and engage with you, we want you to learn, understand and then act. Right? Right, John? And we'll meet you on the radio next Saturday at 11 a.m. right here on KDON.